A change in government spending plans in Germany led to a dramatic move in markets yesterday. Stay tuned and we'll look into the detail. Yesterday, European government bond yields saw a dramatic move. If we take the German Bund as a proxy, we saw an increase of 0.3%, taking 10-year government bond yields to 2.8%. This is the biggest one-day move which we've seen in over 28 years, with fiscal spending plans really being in focus here. We saw the UK gilt market also follow. Yield moves were around 0.15% on the day, so dragged higher as a result of what we saw in Europe. In terms of the cause of those moves, as flagged by Matt Henderson yesterday, it was really the result of a statement from Friedrich Merz, who's the German Chancellor in waiting, around their plans to essentially do whatever it takes to ensure the sufficient defence of the German economy to protect freedom, to maintain peace. And this is all really in response to the aggression which Trump has demonstrated towards Ukraine. Essentially, this means a big increase in defence and infrastructure spending, and furthermore, any spending on defence would be exempt from the debt brake. For context, the debt brake was introduced in 2009 after the financial crisis, and it was there to ensure sustainable public finances in Germany, essentially limiting any annual deficit to 0.35% of GDP. To put this in context, this has been responsible for maintaining much more fiscal discipline in Germany relative to what we've seen in the UK and in the US. So debt to GDP in Germany is 62%, whereas if we look at the UK, it's 95%, and in the US, it's 122%, so much more fiscal discipline. But however, that has also been blamed for a lot of the sluggish economic growth which you've seen in Germany. So in essence, what Merz was suggesting was a €500 billion investment programme on infrastructure. Now, this would be immediately growth stimulative in terms of the German economy, and it's been called for a number of years. Any spending over 1% of GDP in defence would be exempt from that debt brake as well, so it would essentially allow a lot more fiscal spending freedom and allow debt levels to increase in Germany. This led to a big reaction in the bond market. We saw bond yields move higher as a result. Given the inverse relationship, bond yields moving higher, we saw prices fall, so it was a negative day for European bonds. But in contrast to that, we saw a rally in European equities. European equities were up 2.1% in sterling terms, and it was really companies which are more linked to defence and to infrastructure spending which were the big winners on the day. So a very negative day indeed for European bonds, and UK gilts suffered as a result of that, but a very strong day for European equities as a result of government spending targeting infrastructure and defence. But a big change nonetheless. Elsewhere, we saw an update on the sentiment in the US in terms of services and manufacturing. Now, what we saw was two positive readings. We saw service sectors which are continuing to expand. The expectation is still to see an acceleration in growth in the service sectors, with all of the main components of that basket improving. So the reading was 53.5, and anything above 50 is expansion. But where we're seeing expansion is in new orders. We're seeing it in activity, employment, and also delivery slots as well. So quite a lot of demand is still baked in there within the service sector, which is key to the US as a service-led economy. But in manufacturing, after a long period of contraction, we're still seeing positive expansion in the manufacturing sector. But we are starting to see it cool down a little bit. Companies are a little bit more cautious about ramping up production just in light of the uncertainty of tariffs, especially with key trading partners such as Canada and Mexico. But generally, both components were pretty robust in terms of services and manufacturing. So that's all for today. Big move in markets yesterday, negative for bonds, generally positive for equities. Sentiment still pretty robust in the States. Thank you for watching.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.